Well, good evening, everybody. Thank you for joining us this evening. My name is Richard Villanueva, and I will be your host for the Insurance Recovery Webinar Series, a four-part series that we put on in every wildfire event in an effort to better educate those who have suffered major loss. We're going to do our best to try to stay on topic. There are going to be a lot of questions. It must be noted, I am not a professional presenter, and I am here just to give you the information that we have as experts. This particular week's series is going to cover how am I going to handle my claim, either on my own or with representation. If so, who and how do I decide what representation is best for me? And also addressing housing, which is also a pretty big topic right now for a lot of you. What am I entitled to? Can I negotiate? Can I get paid an allowance, which we will address as we go. I am one of the vice presidents of Adjusters International, and I think it's important to know who we are and what we do. We are licensed public adjusters. We have been representing the Colorado community for 30 plus years. We are local to Westminster. And along with our joint ventures that we have with our partners in California and Pacific Northwest, we are the leading experts in wildfire events in the country. And we have allocated 100 employees plus to this particular event who are all wildfire experts. And our lens that we look at your loss through is very specific. It is through the lens of an advocate. In the same way that your insurance agent and that your broker is licensed by the Department of Insurance, we too are licensed by the Department of Insurance. They are licensed to sell the product. We are licensed to negotiate and maximize the recovery. Tonight is nothing more than really giving you some options, and more importantly, to really understand how your policy is going to perform, what all the different buckets of money means, and how to connect those dots. All the information that we give is specifically as an advocate. We are not here to solicit your business. We are here to educate you so that as you travel down this road of recovery, you understand how to better position yourself in the overall negotiation with your insurance company. Understanding the position and the tactics of the insurance company is going to give you a greater sense of power when communicating with them. And hopefully when we're done, you'll have a much better strategic understanding as to how each one of your buckets will respond. With that, we'll jump into the first slide. If you folks were to take your claim and you were to divide it into slices of pie, this would be how your claim would look. And it's important to know where your largest liabilities lie, because that's where you have the greatest risk of recovery and or not recovering what you're entitled to. All policies are the same. There are some that don't have an extended limit, which we'll get into, but for the most part, the components as a whole are all the same. You have your dwelling, which would be coverage A. You have your extended limit to that dwelling potentially. Your personal property recoverable depreciation, which we'll get into, other or separate structures, code upgrades, additional living expenses, debris removal, which is going to be quite a topic in the months to come, and trees, plants, and shrubs. I would encourage you folks, please take a screenshot of this, take a picture, because every one of these particular categories is going to play a very specific role in your overall recovery, because each one of those has a very specific amount of money attached to your particular claim. I'd like to, in advance, give you my information. I will give it to you again at the end. The purpose of this is to really help you better understand. And if you have questions after the fact, you can reach out to me directly. You can call me directly, and I'll give you the advice that I feel is best for your particular situation. My email address is richard@ai- M as in Mary, B as in Baker, C as in Charles.com. Again, Richard at ai-mbc.com. And my direct number, folks, is 720-760-1287. I will give it to you again at the end so that you can reach out to me directly should you choose. So let's just jump into the coverages if we can. We're going to jump into coverage A. Coverage A will represent your dwelling. And when you have a loss, folks, under coverage A, and in a wildfire event, you have technically four, but three primary options. One is to not rebuild at all and to cash out if you so choose. One is to purchase a replacement property instead of rebuilding. And the third would be to rebuild on site if that's what you chose to do. Each one of those will have a different response financially, and it's important to know that as you move forward with the decision that you intend to make, you want to be strategic about understanding how these different buckets of money are going to, what role they're going to play in the ultimate decision that you end up deciding to do. So we're going to kind of just go through some basics here as an example. Again, folks, please screenshot this so that you have something to refer back to and take as many notes as you can. We're going to use the base limit of coverage A in this particular case for dwelling with $1 million example here. In the coverage A dwelling, you have several additional coverages that make up a portion of coverage A. You have debris removal, which is an additional 5%. You are entitled to this 5% regardless of whether you rebuild on site, purchase a replacement property, or just cash out in total. Landscaping, which we discussed earlier, trees, plants, and shrubs is typically always represented by 5% of the dwelling base limit. Now, I've seen some policies this last week that are representative of 2%, and I've seen some policies that don't have any coverage for trees, plants, and shrubs. So again, every policy is going to be different. Every carrier has a different contract that they are in with you. I think it's also important to note, folks, that if you do not have a declarations page that you're able to refer to as you're having conversations with your adjuster, you aren't able to connect the dots between what they're saying and what coverages you have. I cannot stress enough the importance of making sure that you have a certified copy of your insurance policy. The certified copy, folks, is really just the rule book. It is the latest and greatest version of your insurance policy. All of the changes that are made by the insurance company, the endorsement changes, just the language in general, and or any changes that have been made by the Department of Insurance are in this policy. It comes directly from underwriting, and you definitely need to make sure you have that. So first and foremost, make sure tomorrow, if you get an opportunity, send your adjuster an email and request a certified copy of the policy. Now, some of you, unfortunately, are going to be heavily underinsured, and we're already starting to see a portion of that. It's a sad situation to be in, but if you are strategic about your approach to the other buckets of money that you have at your disposal, you might be able to help offset some of that shortfall moving forward. So if you have an extended replacement cost endorsement policy, some of you will, some of you won't. I'd like to explain what that means. There seems to be a little confusion in the way that the adjusters are explaining what your extended replacement cost endorsement is. And we've had cases where they haven't even explained at all that certain families have extended replacement costs. So here's what an extended replacement cost endorsement is. Should your loss measure above the stated policy limit, the term you're going to need to get familiar with, and you're going to hear a lot, is the stated limit. That is the dollar amount that you will see on the declarations page as it's referenced by that particular coverage, whether it's A, B, C, or D, which we'll get into. So the stated limit in this case is $1 million. So if you have an extended replacement cost endorsement and your stated limit is $1 million and your loss is measured above the policy limit, it will unlock that secondary extension of monies available to you, otherwise known as an extended replacement cost endorsement. Now, every carrier and every policy has a different percentage of extension. Most are 20% of coverage A, some are 25, some are 50, and we've seen cases where it literally doubles the policy. Why is this important? Well, it's important to know exactly how much money you have when you start looking at how they're settling your loss, because when you total up all of your recoverable dollars in all of your specific buckets, you have to be able to measure their performance against what you're entitled to, so you can understand the position ultimately that the insurance company may be putting you in. So for this example, again, as I stated earlier, depending on whether you rebuild or you purchase a replacement property or you don't rebuild, the policy is going to respond accordingly. Let's talk about the extended replacement in those decisions. The most money, folks, that you will ever get, assuming that you get to policy limits, the most money that you will ever get as a check in your hand will be no more than your base limit. Period. Doesn't matter who the carrier is, it doesn't matter what the coverage says, doesn't matter what your adjuster says. The most you will ever get as a check in your hand is your stated base limit. Your extended replacement cost endorsement will only come into play when you perform. Well, what does perform mean? Perform means purchase another property potentially, rebuild on site, or rebuild anywhere else in the country, or not rebuild at all. In this particular case, anytime you have an extended replacement cost endorsement and you choose to cash out and not rebuild, you are walking away from that extension. Now, again, some people do and most do not. So you want to strategically position yourself with what your end game is and understand, how does my policy respond to my end game? What is the narrative that I need to put together in order to achieve the game plan, which is whatever your goal is? And you've got to understand how the policy is going to respond. Folks, the policy is a contract as you're moving forward. I would encourage you, don't look at it as a policy, look at it as a contract. The insurance company is contractually bound to you, and you need to understand how to enforce the contractual obligations that the insurance company has. If you do not challenge the position of the insurance company and you allow them to dictate the path of your recovery, certainly it is going to benefit them financially, not necessarily the insured, which unfortunately is why we exist. The Department of Insurance looks at the interaction between the insurance company adjuster, who represents the interests of the insurance company, and the interaction between the insured as a built-in conflict of interest. You can't represent both parties' interests equally. So it is important to understand how to position yourself. So when you're looking at these buckets and you're looking at the money, understanding how to navigate the language of the policy and understanding how it is going to respond to whatever your goal is going to be critical to your financial recovery. Some policies, actually, let me get back to the extended replacement cost. So if you do not rebuild, you will not get that provision. That in this case, $500,000 extension goes away. If you're purchasing a replacement property of like value and size, or you're rebuilding on site, then again, if your loss was measured above the policy limit in its total damage and it unlocked that secondary extension of coverage, then that provision would flow into either your replacement purchase or into your rebuild, and you would have that money available to you. There are some cases, folks, where there is additional increases due to declared catastrophes, but I would say that that is primarily an endorsement that we typically see in the West Coast, where a lot of the wildfires are pretty prevalent. We don't see a lot of that language here in the Midwest. You see it some in the East Coast, but if there is a declared catastrophe and if your policy has that particular endorsement, in many cases, if you have a 50% extension, which is represented above here in the extended replacement cost, it may double your extension by another 50%, giving you 100%, which is technically doubling your policy provision. But I've not seen that yet. We've not seen that yet, and I don't suspect that we will for many of the policies here in Colorado. Also available to you as an additional provision is code upgrade. If you have code upgrade coverage, it will typically add an additional 10% of your base limit for coverage A. Everything always seems to go back to coverage A for the base limit. They're all percentages of, and each policy has different percentages of. So in this particular example, you can have up to 10% for coverage, code for coverage A. You may have up to 100%. Again, it's policy specific, and each carrier has a very different percentage of increase for code. In some cases, it's built into the limit of your coverage A, and it may have language that says you may use up to 10% of coverage A towards code upgrade, but it is not an additional coverage, which means that it reduces your overall coverage for your base limit by whatever that percentage is, and you would allocate those monies to code. Let's define what code means. Code is a use it or lose it bucket of money. If you do not perform and incur the cost for a code related item, the carrier will not issue you a payment for code, typically. A code related item would be something along the lines of sprinklers. If you didn't have sprinklers before and now you're rebuilding and you are required to go back with sprinklers, the cost of the sprinkler addition would come out of that specific bucket of money for code. That money would be allocated to that particular expense, and it doesn't take away from your base limit that you're going to use for the reconstruction or purchase of your replacement property. So again, folks, take a picture of this particular screen, screenshot it. You'll be able to go back and reference it. Again, base limit is the base limit that you see on your declarations page. Debris removal is 5% of the base limit that you will apply towards the debris removal. There will be more questions about debris removal in the weeks to come, which I'll be more than happy to address. Right now, I think it might be a little premature. Landscaping, again, 5% of coverage A. In this particular case, it's $50,000, but you can apply that 5% to your particular coverage as to whatever that is. You'll see language in your policy that will define what they are going to pay per tree, plant, or shrub. In some cases, it's up to 500. I've seen 2,500. So again, very case specific, very policy specific. And then of course your code. You want to know if you have code upgrade because you need to know if that's going to increase your policy overall by that percentage, or is it going to be used and take away from your base limit as a whole. We're going to move on to coverage B, which is other structures. Other structures, folks, is a coverage that you would typically see on your declarations page as coverage B. For those of you who have State Farm, when you look at your declarations page, you will see dwelling extension. Dwelling extension is coverage B on other policies. So I just want you to connect those dots so you understand what I'm talking about when you look at your declarations page for State Farm clients. Other structures are structures that fall outside the dwelling coverage. These are separate structures on the policy that have independent insurance assigned to that particular bucket. It has to be prepared and presented independent of all the other coverages, and to include garages, workshops, sheds, detached fencing, retaining walls, walkways, driveways, patios, pools, for those of you who have pools, cabanas, exterior lighting, and so forth. A visual example that I like to give clients is if you took a home and you plucked it off your property, whatever is left remaining on the property, not directly connected to the structure, would fall under other structures. There has been a misunderstanding in the community that people think because they don't have a separate actual physical structure that it doesn't apply to them, when in fact it does if you have any of these other categories. As you have on your declarations page for coverage A, you will also have a base limit for coverage B. Base limit is typically representative of 10 or 20% of coverage A. Again, the 10 or 20% is specific to the carrier that you have for your insurance policy. You may or may not have an extended replacement cost endorsement for coverage B. Again, that's why you would want your certified copy. Really read that to see if your extended replacement cost endorsement that you have available to you for your coverage A applies to coverage B as well. Some do, some don't. I've seen maybe 20% of the policies thus far that we've reviewed do have this extension that transfers over into coverage B as well. You also have an additional 5% of debris removal as an additional dollar of that base limit, in this case of the 100,000. So 5% would equal $5,000 that you would have towards debris removal for anything related in your coverage B or other structure category. Debris removal typically means the footprint of what burned. So you can apply this to your own property and understand how this coverage may apply to what you have lost specifically. And also code upgrades is an additional amount that you have available to you if you are reconstructing coverage B on your property. If you're rebuilding that shop, if you're rebuilding the shed, if you're rebuilding the detached garage, you have an additional 10% for code as it relates to coverage B as well. Now, again, whatever the extended percentage is for your code that applies to A will be the same percentage that you have that will apply to coverage B. So if you have 100% for code upgrade in coverage A, you can expect to have 100% of code upgrade for your coverage B as well. Please take a screenshot or a picture of coverage B so that you can reflect back and understand how that might apply to your particular property. We're going to go now into coverage C. Folks, this is going to be the most daunting, time-consuming, most frustrating part of your entire claim, in our opinion, just based off the almost 75 years of representing losses. Coverage C in this particular example, you'll see here the stated limit is 500,000. Now, typically built into most personal property coverages, you are going to have sublimits, and there is a misunderstanding in some of the community forums that your sublimits apply to your jewelry, that they apply maybe to your firearms. And yes, there are sublimits in the policy specific to those subjects and those particular items. But those sublimits typically are for theft. In the case of fire, you would not have a sublimit for those particular items. So if you lost a tremendous amount of jewelry, or if you lost several firearms, there will not be a sublimit for those particular items. In some policies, you will also have what are called scheduled items. Scheduled items are high dollar items that you insure independent of the rest of your coverage. An example to that would be, let's say you had a Steinway piano that was $120,000. And in this case, if you have a $500,000 limit, that one line item represents a fifth of your overall coverage. You would probably not want to do that. You would insure that particular line item independent of itself just because of its value. Sublimits that will apply right now would be things like business personal property, watercraft, cash, stamps, coin collections, things of that nature. There will be very specific language in the policy that will represent your sublimits. Business personal property, folks, would be this. Let's assume you had a small business and you did not have business coverage in your home. Let's say you had a computer that you used for your business and it was strictly for business purposes. You've lost that. There may be a sublimit for business personal property. It could be 2,500, it could be 500, it could be 5,000. It just depends on the carrier and the coverage that you have. Let's talk a little bit about actual cash value versus replacement cost value. There are two types of policies typically. You have an actual cash value policy and you have a replacement cost value policy. Basically, actual cash value is just replacement cost minus depreciation equals actual cash value. So again, replacement cost minus depreciation equals actual cash value. And we're going to go into what that means on this next slide. If you have a replacement cost policy, the depreciation that is applied to your personal property is recoverable. But here's what that means. Let's assume you had a couch. The couch is now lost. You spent $1,000 on that couch. The insurance company has applied 50% depreciation on that couch. They say, we're going to give you $500 for the couch, but since you paid $1,000 for it, and it's going to take $1,000 for you to replace it in the market today, when you show us the receipt that you have replaced that couch and you've spent $1,000, we will give you that $500 in recoverable depreciation back. That's how replacement cost works when it comes to recoverable depreciation. If you have an actual cash value policy, whatever depreciation is applied to your personal property, that is the maximum dollar that you will get for that particular item. Now, it should be noted, folks, please take a picture of this because I want to jump to the next page, which will help define how we look at depreciation and why, being diligent and forensic in your descriptions is going to be critical. Common questions on inventory. Right now, we're seeing two types of inventories that are being offered by the insurance companies. One would be a category inventory where they're taking groups of your personal property, they're grouping it together into categories and then applying a particular value to that group. That is a fast way to recover monies for your personal property, but it is not the most accurate, and in many cases can leave you with a shortfall if you don't properly value each one of those groups. Typically, you're going to leave money on the table if you do a group inventory. We recommend always doing a line item inventory. It is one that is much more forensically accurate. It provides greater descriptions, it controls the depreciation, and it gives a lot more data as to the replacement cost for a particular line item. So in this particular example here, do I need to list every item? Well, and then it goes back to, do you want to do a category inventory or do you want to do a line item inventory? If you were to put albums and you put that you had 10 albums in your category, you may generate more money if you put 10 albums and each one of those albums has a specific and unique value. So if you put one value of your 10 albums in your category of 100, but the line item inventory would generate, let's say $200 in value, because now you're being specific to each line item, certainly you're going to generate a much greater return in a line item inventory. But the trade-off to that is that it's much more time consuming and very taxing. So we're going to get into some tips and tricks on the next one here as we move forward. Do you need to list every item? We recommend you list every item. It is a daunting task, but it's going to garner the greatest return. How do you list every item? Well, some of the insurance companies that we've seen in this particular event are asking for receipts. Where did you purchase the item? And this really is not necessary. It's not expected that you may have receipts from purchases from 10 or 15 years ago, much less 2 years ago. And where you purchased the item or how much you spent on that item does not play a role in your overall recovery. Remember, folks, you're entitled to what it would take to replace the item in the market today. Even if you bought something 5 years ago, but to replace that particular widget now is 3 times the cost, and you can demonstrate by providing the defendable data to support the valuation of that line item, it is what it is. What it's going to take to replace the item is what it's going to take to replace the item. So when they start looking at your personal property, they are going to apply depreciation across the board. Now, depreciation, folks, is driven by age, it's driven by condition, and it's driven by useful obsolescence. So an example that I like to give is, let's say you had a guest room And in that guest room, you had furniture and you never had any guests, but it's brand new furniture. You bought it 10 years ago. You may have had guests that have stayed at your home 2 or 3 times over the last 10 years, and they used that furniture. Well, is it fair for the insurance company to depreciate that bedroom furniture solely based off its age if the condition of that item is like brand new? No, it's not fair to you, the insured, because the more depreciation that they can apply to your particular item, the more money they're holding back in your recovery, which ultimately means the more money that they have to control and they have the leverage against you. So if you don't perform and you don't replace that personal property, which we'll get into, then who gets to keep that depreciation that they're holding back against your personal property? Well, the insurance company does. So there's ways around that when you're being very strategic. So in this example here, we're going to use a couple different line items. And again, folks, you are not obligated to submit your personal property in the format that the insurance company is requesting it in. You can put your personal property together in any format that you choose. You can be as forensically detailed as you want to be and submit it to them, and they have to take that under advisement and consider it as your product. So in this case here, we're going to use a pair of women's jeans by Riders, vintage. It's very different if you just put women's jeans and you don't put a manufacturer, because if you don't put a manufacturer in a line item and you're trying to describe that line item, you're leaving it up to interpretation and you're allowing the insurance company to dive into their database where they have discount sites, overstock sites, and they have their own database that they will use to price certain items. So the more descriptive you are in your inventory, the less likely they are to interpret what they are looking at. You want to make sure it's very clear. So in today's replacement cost, those jeans would be $100. The source that you intend to purchase them at might be Macy's or Nordstrom's or wherever. Now, the insurance company is applying a depreciation of 50%. Because you didn't do anything to control the depreciation. You weren't aware that you could control the depreciation. So the carrier says, we're going to depreciate that 50%. So of the $100 that you're owed for replacing that one line item, they're applying 50% of the depreciation. They're paying you $50 of the $100 that they owe you. And they're withholding that $50 until such time that you submit a receipt to them showing them that you have replaced that $100 pair of jeans. They will give you back that $50 recoverable depreciation. Now, folks, I'm a realist and I'm just going to tell you, expect that you are going to go and replace every single line item is not reasonable and it's not realistic. Your life has changed. Your life will change. Your habits have changed over the course of or will change over the course of the next 2 years. Your spending patterns and your habits will change. And the insurance companies know this. And they know that you are not going to go back and replace 100% of those items. And so if they roll the dice and they're able to hold back a huge chunk of depreciation and you never replace any of those line items, they win. They get to hold all that money. It's your money. You should be able to position yourself to recover that money. So let me give you a couple ways to consider how to approach your personal property. Personal property, when you're putting together that inventory, take your time first and foremost. Don't rush it. Take your time. The more time you take, the more accurate you're going to be, the more data that you're going to present, the better your financial recovery. If in the case previous, there's a $500,000 limit for personal property, you will want to measure your personal property about 40% over the policy limit. Because the goal is that even after depreciation is applied to your personal property, the dollar amount, the actual cash value that the insurance company owes you is at or above policy limit. It forces the insurance company to cut you a check for your policy limits. If you have replacement cost policy endorsement, you want to try to get away from the receipt game as best you can. You want to produce something that forces them to get you to the policy limit. The same thing would be for your actual cash value. If you know you don't have access to a replacement cost depreciation recovery, then you want to make sure that you're producing a product that gets you so far above that the actual cash value is at or above policy limit. We're running a little late, so let's just jump to the next slide here to give you some tips on inventory. You really do have to kind of train yourself to go through and understand how to hyper focus on your personal property. Again, it's the most time consuming, it's the most taxing. We have amazing resources that I'm more than happy to pass along to you folks, and we as a team are more than happy that will help you in this recovery process should you choose to do so on your own. Keep a pad and pen with you at all times. Keep it in your car, keep one next to the bed. And as you come up with an item, just write it down. It doesn't have to be in any particular fashion. Just get it out of your brain and write it down so you can reflect on that later. Draw out each room one by one, but I'm going to go a little further than that. If you have a multi-level house, we recommend that you take the top floor and draw an aerial perspective of that floor. Identify where the closets are, identify where the beds were, the dressers, the end tables, the linen closets, the bathrooms, but do so from an aerial perspective. Look down onto that. Do the same for your first floor, and if you have a basement, do the same for your basement. And as you approach the drawing and the aerial perspective, as you look into a room, because our normal mind's eye wants to take us into the house as if we're walking into the property. So change the view and look down. It gives you a different perspective on the property, and it helps you fine tune what it is that you have lost. And take that room that you're going into and break it into quadrants of 4. Just take an X and draw it right through that. And jump into that one little quadrant, folks, and work clockwise in that quadrant and go up the wall and down the wall, across the floor, and capture everything that was in that small quadrant. And then jump to the next quadrant, and then jump to the next. And give yourself some time limits, folks. You know, when you're visualizing your drawers and your closets and the shelves, the drawer in the closet, what's under the beds, you want to make sure that you allow yourself time to go through that memory. And don't put an unrealistic time frame on yourself so that you're feeling undue pressure, because it really will start to creep up on you. So give yourself an amount of time. Do it for an hour a night. Shut it down after an hour. You've got plenty of time to get it done. There's not a rush. Take your time and do it right and go slow. Use family and friends. Everybody wants to help in an event like this. If you have categories of things that you've already put together and you have the list of where you intend to buy that item from to generate your pricing to support the valuation of that particular line item, because remember, you want to tell the insurance company what it's going to take for you to replace it today. Give a handful of items to your family members. Let them do some pricing for you. I would also encourage you, set up a Dropbox, set up a Google Doc where friends and family who have ever been in your home for Christmas or Easter or Thanksgiving or birthdays or anything that you may have celebrated over the years, where people have taken pictures. It will be instrumental in your recovery if you're able to look at some pictures and not only see your personal property in the background, but also to help you when you're looking at what you had, or your adjuster needs to see what was when they're trying to generate the estimate for the replacement of your property. It's critical that you be as accurate as you can to generate the greatest return of your particular coverage. The next claim here is additional living expense versus fair rental value. This is specific to housing. It's for coverage C typically, D for most policies. And the policy will be specific as to how it responds to your housing. There are so many options in this particular coverage that I won't go into the specifics on this. I'm happy to take it offline because there really are a lot of very specific strategic options. But in general, we'll go through what these different coverages represent. Additional living expense covers your temporary housing, whether you're in your temporary Airbnb right now, a temporary house, which is your long-term temporary housing, or the hotel that you might be staying at currently. It covers the rental furniture costs. So when you finally move into your long-term temporary housing, And there is a furniture package that you get to pick from that will furnish the home for the time that you're occupying that property. That covers that expense. Increased mileage, folks. There is a very specific app that I would recommend for those of you who may have an Apple iPhone. It is called Mile IQ. Mile IQ will start tracking your mileage as soon as you get in your vehicle, and as you start to travel throughout the day, it records all of those different travels, and at the end of the day, you can swipe left or right if it was a business or if it was a personal travel. And you want to keep track of the mileage, because if you're traveling farther to work or farther to school or farther in general from where you lived and now your temporary house is 3 or 4 miles out, you're entitled to be reimbursed for that mileage at the end of the year. So it's best to keep track. I mean, it might represent $2,000 or $3,000, but certainly it's money that you're owed. Animal boarding. If you have animals that are currently being taken care of by friends or family, they are entitled to be paid as if you had your animals in a boarding facility. Your pets are entitled to be boarded during the time that you are trying to find your temporary housing. So that is an expense that is also covered under your additional living expenses. And that particular bucket, folks, is going to be driven by an amount of time, or it's going to be driven by a dollar. If it's driven by a dollar, I would encourage you to take the dollar amount that you have in that coverage, divide that by 24, given this might be at least a 24-month process, and make sure that the dollar amount that you are spending for your temporary housing will accommodate and sustain you for the next 24 months. If it doesn't, then you may want to readjust what you're spending per month for your temporary housing to make sure that you don't run out of money in the middle of your project. Fair rental value, if your policy does offer that particular option, it is what your home would have rented for at the time of the fire or just before the time. And so in some cases, many people opt, if they have this particular coverage and they can't find any temporary housing, they would prefer to just have the insurance company pay them every month, and then they will find housing on their own. It's important to note, folks, that carriers owe for increased costs due to limited housing. If there is a housing shortage, unfortunately, which in this particular case there may be, and the cost to rent a like type home is more than what it would normally be in the market, the insurance company is obligated to pay that additional cost for your housing. So please don't let them pigeonhole you into a corner where they say they're not paying for something. They must give you reasons why, and it must be represented in the language of the contract. With that, who can represent you? Should you consider representation? And again, I'm not here to say you need it or you don't. I am here to explain what your options of advocacy are so that you can apply that to your own particular situation and determine if representation in any form of advocacy is in your best interest. Attorneys can certainly represent you, but it's important to note that attorneys don't do what we do. Attorneys have a tendency, no disrespect to attorneys who are representing losses, to take a more reactive role to the carrier's position as opposed to a very proactive role. Remember, folks, you are obligated to prove the value of your loss to your insurance company. It is not the insurance company's obligation to pay you what you are entitled to. They're only going to pay you what they believe that they owe you, because you are filing the claim against the insurance company. So you have to figure out how you are going to prepare this particular claim and present it to the insurance company in a defendable format that forces the carrier to respond financially. Public adjusters, which is what we are, our firm, we are advocates for the insured. All we do is represent the insured. That's it. We have an infrastructure to support each particular coverage as it applies to you. Coverage A, coverage B, coverage C, and coverage D. We have the infrastructure to go after the valuations and prepare that claim in such a way that we're producing a particular product for your coverage A, we're producing a defendable product for your other structures, we are producing a product that represents your entire personal property loss, and if need be, and a family needs us to get involved and communicate and negotiate housing, we do that as well. Contractors, agents and insurance agents and insurance brokers do not get involved in the negotiation of a claim. They are not licensed to negotiate the claim. As I mentioned earlier, your insurance agent or broker is licensed by the same departmental entity that we are, the Department of Insurance. Their license is specific to the selling of the product. Our license is issued and is specific for the negotiation of that product. Contractors do not have the ability to negotiate a claim. They are not producing the product in a defendable format, nor is the carrier obligated to take that into consideration, and they are not licensed to do so. So be careful if contractors are telling you folks that they can prepare and negotiate your claim. That is absolutely false and inaccurate. So if you're looking at representation and advocacy of any kind is what you're considering, make sure that it best represents your interests and make sure that it's not going to harm you financially. With that, I think we can jump into some questions. We have quite a few, but again, here is our email address, folks, our 800 number. I've given you my personal contact information if you'd like to reach out individually and schedule time. I'm more than happy to go over your policies with you. I'll block whatever time you folks need, as will the rest of my team. Discuss the pros and cons and give you a much better forensic overview as it applies to you specifically. So some of the questions that we have here is attached garage is not considered as an other structure, correct? That is correct. It is part of the actual dwelling under coverage A. So an attached garage would fall under the overall structure as a whole for your coverage A dwelling limit. The next question that we have here is, what is the extended to coverage C? Well, if you have an extension for coverage C, it will be listed in the declarations page. But I will say that in most cases, there is not an extension for coverage C for personal property. It would be either an actual cash value settlement or a replacement cost where that recoverable depreciation, you're entitled to recover that depreciation. So it's either going to be an actual cash value or it's going to be a replacement cost value. But rarely do we see extensions on personal property. I'm not saying they don't exist, because they do, but we don't typically see that across the board. And so I've not seen one yet in this event. And so if there's more to that question, I'm happy to answer it, but I want to make sure I'm addressing your extension coverage question as it relates to whether it's depreciation driven or overall coverage amount driven. If you're asking if there's an extension that increases your personal property coverage limit as a whole, I have yet to see that in any of these events or in general. Most policies don't have that. Is that it? So folks, thank you for taking the time. I appreciate it. We will have another recap of this on Thursday. Again, our goal is just to really give you the information as we see it, help you better understand how your policies respond, give you the knowledge that you can start to compare and contrast as you're communicating with the adjusters. I didn't get into the adjusters, but I can quickly if you'd like. The adjusters that are coming in from out of state represent the interests of the insurance company. They do not have the authority to make any kind of financial decisions as it relates to your claim. I cannot stress enough that you want to heavily document your claim. Try to keep all of your communication in written form. If you do have conversations with your adjusters, please reiterate and memorialize that conversation so that it makes it to your claim file. And again, we're here to give you any guidance, any advice that we can, do policy reviews for your folks. And if you feel that representation is what best represents your interest, great. That's a different discussion, but that is not what the purpose of this is over the next 4 weeks. It's really to help you better understand how and what you should do to best manage your claim. I wish you well. I'm sorry that we're meeting under these conditions. I thank you very much for your time. If there's no additional questions, I thank you, and we'll go ahead and end this evening. And I wish you all well. Thank you so much.